Right, so we are now turning our attention and getting a little closer to home in terms of our securitisation market specifically. I would like to welcome Jennifer Wu to the podium. Jennifer is a Vice President and Senior Credit Officer with Moody's Structured Finance Ratings Group based here in Sydney. She's responsible for the management of the primary rating team and a lead analyst herself for Australian residential mortgage-backed securities, asset-backed commercial paper and covered bonds. Prior to joining Moody's, Jennifer worked within the securitisation industry with Perpetual and Rams Home Loans amongst others, and also is a lawyer by training, having worked at the then Mallison Stevens Jakes. Jennifer is going to moderate a panel, and the panel will be discussing Australia's resilient landscape and what's ahead and how we measure up globally. Please welcome Jennifer.
Good morning all. Thank you for coming to this session. First, before we start, I'd like to call up our panelists. So if I can first have Matt Secosta. So Matt is an economist in the Sydney office of the Moody's Analytics team. His primary coverage is Australia, New Zealand, and some of the Asian economies. The next panelist will be Tim Lawless. So if I can have Tim there. Tim is the research director of pt2. So he's got a wealth of experience in terms of the property and data research and in the consulting sectors as well. Third is Arthur Karabassos. So Arthur is the head of our Asian research at the Moody's Sydney office. He also covers research in the Asia-Pacific regions for structured finance. Prior to him taking this role, he is a lead analyst in RMBS and asset-backed commercial papers. May I also ask Paul Caputo to come up, please? Paul is the Chief Risk Officer, Senior Vice President of the Capital Markets at Genworth. Paul has got a wealth of more than over 17 years of experience in the insurance and the financial sector services. So he's got a very good knowledge from the insurer's point of view. Last but not least, and I'll have Graham Mott. Graham is a partner with Deloitte. He is very much involved in the securitization industry, working with a lot of the RMBS and ABS issuers. And recently, we noticed that they have also just published the Deloitte's mortgage reports as well. So today, our topic is Australia's resi landscape, what's ahead and how it measures up globally. When we often talk with offshore issue investors, they often a lot of divergence in their views in terms of the Australian mortgage market. Some has got a very positive spin on it, some might be a bit more negative, and some might not care that much. So today what we are hoping to do is actually to have our panelists provide different views from different angles in the mortgage industry and in securitization industry, to provide their views on how they actually see the mortgage market in Australia. The panel will start with some keynote presentation from Matt, who will provide an overview of the Australian economy, and then followed by Tim, who will provide an overview of the Australian housing market and the outlook. After that, we will then open the forum for a very short Q&A session. So as you have seen or be very experienced already, that there is actually an SMS service where you can actually SMS your messages. We will then take maybe 2 or 3 questions from there. And don't worry if your questions are actually missed out. We will definitely save them to the end of the panel discussion, where we will open for to the forum for a Q&A sessions again. So without further delay, I'd like to introduce Matt, who will then provide us with an overview of the Australian economy.
All right, good morning, everyone. My name is Matthew Secosta. I'm an economist at Moody's Analytics in Sydney, the sister company of Moody's Investor Services. However, we don't make any comment on ratings. This morning, I have 5 minutes with you, so I'm going to run pretty quickly through our global baseline outlook and our Australian baseline outlook. I'll also discuss the risks to the outlook, which are mostly to the downside, and run through some scenarios about how these would play out if they were to occur. Now, it's very interesting being an economist at this stage of the cycle, and most of the interest lies overseas. So let's start with our global growth outlook. And policymakers overseas are now starting to respond to the European crisis and the slow growth in the US. We've recently seen the US institute a third round of quantitative easing, where it will buy long-term financial assets to push down interest rates. The US economy is growing around 2%, but at this stage, that's not fast enough to meaningfully bring down the unemployment rate. The European Central Bank has also announced a bond buying program. Well, it will buy bonds of the troubled sovereigns in the periphery. Now, that's helped lower long-term government bond yields, but clearly it hasn't been the silver bullet that's ended the crisis, and there's a lot of uncertainty plaguing markets and a lot of weights on the Eurozone economy, not least high unemployment, wage cuts, fiscal austerity, and a lot of the disenchantment that the public has with the political situation. And that's creating a lot of uncertainty across Europe and across the globe. More importantly, for Australia, the slowdown in the Western world has certainly caused growth to weaken in China and a lot of Australia's main trading partners in Asia, such as India, Japan, and Korea. That said, there are signs that Chinese growth has stopped decelerating and is now stabilising through the third and fourth quarters, and we think that growth will start to improve slightly over the coming year. Trade indicators show that the global economy is starting to heal. The government is boosting its fixed asset investment programs, particularly in the rail, water and utilities sectors, and we are starting to see some stabilisation in industrial production as well. Now, we're less worried about a Chinese hard landing than we were, say, 3 to 6 months ago, but in any case, a lot of the doom and gloom on China is often overplayed, particularly in the near term. The economy can't simply continue to grow at rates around 10% like it did in the early 2000s, and the government is successfully bringing growth down to a more sustainable or trend level of around 7.5%, and we expect that to be the growth moving forward. Now, against this backdrop, the Australian economy is holding up pretty well. We've got growth around 3.5%, unemployment rates around 5 to 5.5%, and it's been there for pretty much the last 2 years. Now, the two-speed economy that we all read about is certainly still playing out, and the weakness in domestic facing industries is relatively well known, and Tim will talk about housing, and Arthur, and we'll talk about tourism and a lot of the factors that are weighing on those industries. But recent concern, as we're all aware, is certainly centred on the end of the mining boom, but clearly there's still a massive investment pipeline that's coming through the works. We have over 260 billion worth of mining projects slated at the advanced stage, according to ABARE Economics, and that's worth more than 18% of GDP. So the recent cancellations we've seen in some projects certainly takes the cream off the top of the cake, but overall we've still got a massive investment pipeline coming through, and there's still plenty of reasons to invest as well, because the Asian economies, whilst they've slowed down recently, we still send over 70% of our exports there, and they're expected to continue to outpace the rest of the developed world moving through the coming decades. So there's plenty of reason to invest for the miners and all industries. Overall, our baseline outlook calls for 3% growth in 2013 after 3.8% in 2012. Let's discuss some of the risks, and mostly these are to the downside and largely external. A hard landing in China or a Eurozone shock would certainly result in some tightening in credit markets or a downturn in financial markets. We'd see weakening in business and consumer confidence, and that would also lead to lower Australian exports and then knock-on effects for hiring, investment and wages as well. So clearly there are risks, but they're mostly to the downside. At Moody's Analytics, we produce not only the baseline forecast, but we have a number of alternative scenarios, upside and downside. And in our global slump S4 scenario, which is a combination of a Chinese hard landing or a Eurozone crash, we would undeniably see Australia enter into recession in 2013 if that was to occur, and we'd see the economy contract around 0.7%. Now, if I can just conclude quickly, the economy is not booming, it's not sinking either. Growth is expected to be around 3% in 2013. Unemployment will hover around 5.5%, and we've still got pretty solid population growth to go with that. One of the key takeaways I have is that it's better to be hitched to Asia rather than Europe. However, we're certainly not immune to the developments overseas. Importantly, Australia does have plenty of ammunition to respond to any future oncoming crises. The government has a very healthy debt position with low government debt, so we could certainly institute fiscal stimulus if needed. And certainly the Reserve Bank of Australia has plenty of scope to cut interest rates from its current 3.25%. Thank you very much. I'll now pass on to Tim.
Good morning, everybody. I'm giving you the 5-minute wrap on the housing market, which is quite a challenge. Okay, so I apologise in advance for flying through this at a fairly high level. I'll start with just giving an intro on how property markets or dwelling values across Australia have travelled throughout the past decade or so. This graph tracks the RP Data Rismark home value indices, so using our end-of-month values. And the rolling 12-month trend line, which is that black trend line rolling through the graph, clearly shows an indication of what you might call momentum in the marketplace. We have seen that trend line turn, and the quarterly trend, which is the rolling green columns in the marketplace, clearly shows that towards the end of the series, over the past 3 rolling quarters, we've actually seen dwelling values start to once again show some improvement. Interesting to note, our property market here locally in Australia did peak back in about 2003, early 2004. Quite different to the US, where the market peaked in 2005 after quite consistent year-on-year capital gains. We have had much more of a cyclical market here. In 2008, you can see our housing market did suffer a downturn. We saw values fall by a little bit less than 4%. Over the a little bit less than 5% over the 2008 period, of course brought to quite a sudden halt by a lot of government stimulus. We saw the first home buyers grant boost really drag the housing market out of the consolidation it was experiencing, and that was quite a strong catalyst for some economic growth as well. Looking a little bit more granular though on the housing market, I'd like to just share with you our daily index, and we of course update this index every day on the RP Data website as well as on the ASX website and Bloomberg and Reuters. What it's showing is a lot more granularity here in the marketplace. So you can see, for example, when the market peaked, which is back on November 17th, 2010, you can see when we reached a recent trough as well at the end of May. Since that trough in May, we have started to see some improvements in dwelling values. Interesting to note though, as we moved into October, we have seen a slight fall from that September peak. If you want to look at that a little bit more closely, this is the graph, the trend line tracking the market trough to Sunday. Okay? Clearly what it shows is there has been a recovery underway, probably fueled by lower interest rates. Pretty encouraging. But as of the 1st of October, we have started to see once again a decline in values. The first 21 days, values are down by 0.8%. So I think when we do release our end-of-month data for October, it will show, after 4 months of values improving, another modest fall in dwelling values across the country, which really highlights the fact that the recovery we're currently experiencing is quite tenuous and does face some pretty significant headwinds, probably most significantly in labour markets and also in consumer confidence. We are starting to see across the cities quite a different dynamic. And I'm just sharing with you the quarterly change in dwelling values across the capital cities of Australia up to the end of September. So we are still seeing, I suppose, some weakness in some markets like Hobart, not a great deal of drivers in the Hobart marketplace. Perth also a little bit shaky, but I think the dynamic of Perth has really changed. We are starting to see volumes ramping up. But in every other capital city, we have seen over the last 3 months an improvement in property values, which is quite encouraging. We're also starting to see some improvements in our vendor metrics. There's 3 different vendor metrics we follow, which are time on market, which is average selling time, the average level of vendor discounting, which is how much negotiation is in the market, how much are vendors knocking off their asking price to make a sale, and clearance rates, which is on the next graph. So we have seen selling time stabilise, currently taking about 58 days or 2 months to sell a home, roughly about the same as what it was last year. You can see there's some seasonality in the reading there. Properties take longer to sell in January. But we have seen vendors discounting less as well, which is another good sign. Part of that is explained by the fact that vendors are starting to become more adjusted to market conditions. They're not setting initial asking prices that were potentially as high as what they were back in, say, 2010 or 2009. But also I think vendors are starting to slowly claw back some leverage in the marketplace. There are still a lot of listings in the market, of course, and that's one of the headwinds as well. There's a lot of effective supply, particularly in cities like Melbourne, where supply levels have really built quite rapidly. There's our clearance rates. I know it's a bit of a jumble, this graph, but I've only plotted the weighted capital average in the 2 major auction markets, Sydney and Melbourne. But you can quite clearly see there is an upwards trend in clearance rates, reinforcing the fact that buyers and sellers are starting to once again become more closely matched. Just to sum up, I'll leave you with my lengthy disclaimer as I sum up the market. I think looking forward, the marketplace is quite precariously balanced. We are in a marketplace where interest rates are moving lower, affordability has improved, but we're also seeing labour markets show some tightness. We've seen the unemployment rate rise up to 5.3% in trend, 5.4% seasonally adjusted, and probably will move a bit higher. We're also seeing consumer confidence not responding to the lower interest rates as it normally would. Based on Gemworth's index, which is a fantastic consumer sentiment index, as well as Westpac Melbourne Institute, both of those indices showing a small improvement upwards on the back of lower rates and some slight adjustments upwards in consumer confidence. But I think broadly, consumers simply don't have the confidence to make high commitment decisions just yet, and that's very much reflected in transaction volumes across the housing market. So despite the fact that we are seeing some some small upwards movements in dwelling values, it is on the back of very low volumes. Transactions are running at about 15% below the 5-year average. I'll leave it at that. Plenty of options for questions there. I'll hand it back to Jennifer.
Thank you. Thank you, Matt, and thank you, team. So we will open the forum for a very quick question time. I think we are intending to cover about 2 questions, and then we will hop onto our panels for further discussions. So please, as I've already been on the screen, please text your question to 0429 883 481 and type in keyword ASF 2012, and then with a space and then your questions. So. No questions yet? I might save the best for the last. So if not, then I might just open the forum to our panelists here. If I may just start with Arthur. So Arthur, in your recent, you've just published your heat map report. May I ask how you're seeing as the performance of the RMBS portfolios in the last 12 months, and are there any sort of key observations you have out of this exercise and study?
Yeah, like you said, just published a heat map report that came out late last week, and what that report shows is that over that last 12 months between reports is we saw national delinquencies decrease slightly. They decreased 7 basis points to around 1.82% of delinquencies, and that's down from 1.89%. So a slight improvement, or as Guy DeBell said yesterday, moving sideways. But looking at the national delinquency rates gives no real insight into the mortgage market or really delinquencies and what's driving them. To do this, you really have to look down at delinquencies, not even at the state level, but really at a regional level. And here, changes in delinquency and overall delinquency rates vary greatly. For example, in Queensland, in the Wide Bay region, which is close to the Bowen Basin, where we've got large coal reserves up around Bundaberg Way, delinquencies fell by a quarter. They fell down to about 2%, and that was from the 3% levels of previous 12 months ago. Whilst in the West Moreton region, delinquencies actually increased by about a third to 3%. So we see variations in changes in delinquencies even within states. And even within major cities, like in Queensland, like in Sydney, we observe overall delinquencies vary greatly from regions, even within cities. And for example, in the outer Western Sydney region, where we have the highest delinquencies in the country, according to their report, delinquencies are 3.2%. But then you look at the lower North Shore, also within Sydney, and that's only 0.8%. So you see a 4 times difference in delinquencies, even within a major city like Sydney.
And what do you find as these kind of the common causes of these observations or these kind of regional divergence, Arthur?
When we break it down, without trying to given the time that we got here, I think the variance within the regions is twofold. One is the strong Australian dollar, and the other one is construction. Coming off what Tim was saying about sentiment, I think construction is sentiment-driven, and then the Australian dollar is hitting people in tourism, retail and manufacturing. So just to give a little bit of context about the Australian dollar, for about the last 22 odd years, the Australian dollar used to trade around 50 to 80 cents to the US dollar. Since the GFC, it strengthened, and now for the past about 2 years, it's been trading at par or better than the US dollar. So previously, the economy was geared to operating within that 50 to 80 cent range. Now we're seeing the economy having to adjust, operate at par with the US dollar. And to give you a bit of an example a clear example of how this has impacted, for instance, tourism, we've seen Australians in record numbers travelling overseas. The recent ABS numbers showed that for the first time we're seeing more tourists departing Australia than actually new tourists arriving in Australia. So that's hit really the tourist regions. And the tourist regions that we're talking about is the Gold Coast, lower Western Australia, so that's the Margaret River region around there, the Sunshine Coast, Richmond Tweed, far northern Queensland, which is around Cairns region, and the mid-north coast of New South Wales. So we see those regions being hit hard. And actually they're probably, all of them are performing at delinquency rates of above 2%. The other factor with construction, it's interesting to see that when you take a look at the Gold Coast and the Sunshine Coast, they've got the proportion of workers in construction in there is about 15% compared to the national average of about 9%. So we're seeing those areas copying a double whammy. So they've got the problem with tourism down and the problem with construction down. Give a bit of an example, a bit of context about construction. For the past, since about, I think August 2010 till now, when the latest figures came out, construction is down 20%. So regions with construction and tourism are hit quite largely. Retail, don't need to say much about that. People are buying online, the strong Australian dollar. Mums are finding they can buy their jeans quicker, easier, and more importantly, cheaper online. Manufacturing, I think we've all heard the stories about, the manufacturers, the car manufacturers finding it hard. So those regions are really finding it hard. So it's sort of, the question is, well, what's left? If tourism, manufacturing and retailing are being hit, what's left? But when we take a look then at the regions which are performing relatively better than the rest of the country, what we see is we find they've got a higher proportion of their workforce classified as professionals or jobs in education. And also, in the case of the ACT and Northern Territory, fairly high proportion in government jobs, obviously, so government jobs, more stable type of jobs. And the other thing that we've observed is also in the regions which are performing relatively worse is the long-term unemployment rate is higher. And by the long-term unemployment rate, we looked at the 10-year average unemployment rate, and in those regions it was about 6% compared to the national average of about 5.4. In the regions which were performing well, we saw a lower, much lower long-term unemployment average of about 4.7% compared to the national average. So they're the key drivers in a nutshell.
Matt, as economist, what do you think about Arthur's observations or view on the regional or sectoral sort of performance divergence? Does that echo from an economic performance point of view as well?
Yeah, definitely. I certainly agree with everything Arthur's just said. There's sort of an east-west divide where the west is performing very, very well and the east a little sluggish. And the RBA is trying to account for that and adjust for it, and so that's why they've been cutting rates over the last year. So we hopefully should see some narrowing in the two-speed economy, where the domestic-facing industries such as retail, tourism, education, manufacturing start to pick up as the interest rate cuts start to flow through. So we should see some narrowing in the gap. But I certainly agree with Arthur's thoughts on the tourism factor. I mean, I was just recently in Europe, and on a lot of the tour groups I went on, there was a hell of a lot of Aussies overseas. We were outnumbering the Americans and the Germans, and so clearly there is an appetite for travelling overseas, and that's certainly going to weigh on some of the far north Queensland economies.
Sure. Paul, turning to you, how are you seeing as the mortgage market performed in the last 12 months? And what are the key factors that you think has driven those performance? Is your view different or sort of in line with also Arthur's observations as well?
Yeah, similar to what Moody's is showing in their analysis, although I think we're probably a 9-month difference in sync. So if I take the Genworth portfolio as a proxy of the mortgage market, albeit it's at the pointier end, we saw arrears really rise fairly strongly through the latter half of 2010 through 2011 and peaked in Q3 of 2011 at about 59 bips. Now that's 90 days plus arrears. We've actually seen that as an inflection point, and we've actually seen quite strong improvement in overall arrears rates sequentially each quarter, and at Q2 of this year it was sitting at around 52 bips. The key drivers that we did see, and I'm going to look at it through two lenses, and we actually look at it at an individual borrower level. The key themes that we saw coming through were firstly reduced income was the key driver, and this is really related to underemployment as opposed to unemployment, but of course unemployment was also a factor there. The other key driver was rising cost of living. Interestingly enough, we saw the third component as rising interest rates. What I mean by that is during the 2010-11 period where interest rates did rise fairly strongly, we were expecting that to see that as the key driver, but it really came down as a third one. And the fourth one is declining house prices. Not that declining house prices force people into arrears, but declining house prices reduce the ability to effectively move out of your position. In other words, sell the house, you've got a net positive, you pay off the loan, and everyone is kind of happy except the borrower. If you look at it from, though, a portfolio perspective, the themes that we were seeing in the book were very similar to what Moody's is showing up. Firstly, we were seeing from a segment perspective that self-employed were particularly being more stressed than the salaried or PAYG borrowers. Now, if we look at the Genworth Home Buyer Confidence Index in September, we found that 26 of mortgagees that are self-employed, 26% were actually had some difficulty in meeting their repayments over the last 12 months, and that compares to the average over all of the respondents of around 12 to 13%. From a regional perspective, we definitely saw Queensland experiencing significant stress, and in particular we did see it coming through the Sunshine, the Gold Coast and far north Queensland, so similar to, again, what Arthur just went through. But also what we did see is it was particularly in the 07 and 08 originations. Now, the market and the LMIs did strengthen policy towards the end of 08, early 09. And so what we have seen is that the development of the later originations, being kind of mid-09 onwards, are actually developing very favourably. We're seeing very low level of arrears coming through those particular books. So we've actually seen a stronger improvement in arrears coming through, and we are particularly seeing it coming through in the latter books or latter originations. The other point that I would also mention is we have seen more elevated arrears coming through the WA market, not as bad as Queensland, but not far from it. So we're not necessarily seeing as significant a benefit from the two-speed economy, where we are seeing definitely elevated arrears in the WA market.
Sure, thanks, Paul. And Arthur, as Tim has, pointed out in his keynote presentation, that obviously different states have got the different degree in terms of the house price movement. Some states perform better than the others. Do you see that, from a performance or delinquency perspective, it sort of follow the same trend as the house price movements for those different states?
Interesting, because Tim was talking about house price movements, and a lot of people sort of focus on house price movements to take a look at as a protection for delinquencies. But I've got a slide if you can bring it up.
I can turn to slide 3, please.
Yeah, so what I've done here is on this slide, on the vertical axis, we're looking at the Sydney regions around Sydney. And on the vertical axis, I've listed all the regions around Sydney in order of LTV. So the highest LTV up the top and the lowest LTV down the bottom. On the horizontal axis, what we've plotted is the house price movements. And we've used actually Tim's RP data to do that for each region. Now, those bars there which show the house price movement, what we've done, we've overlaid the delinquencies. So red being higher delinquencies, green being lower delinquencies, yellow being average delinquencies, if you like, delinquencies in the middle. So what we're trying to do is overlay LTV, house price movements and delinquencies to see what's the driver for the delinquencies, especially within markets within, say, Melbourne, and looking at relative delinquencies within markets, so Melbourne, Brisbane, Sydney. And what you find is, it's interesting that if you take a look at lower north Sydney, you see there that they had a house price decline over that period of a year of 14%. However, the delinquencies, it's one of the lowest in the country. So this notion that the house price declines in and of themselves is going to cause delinquencies is really not there. And when you take a look at other regions, like out of southwestern Sydney, they only had a house price decline of 1.5%, but they've got one of the highest delinquencies in the region, in the country, or actually they have got the highest delinquencies in the country. So you've got to ask yourself, well, what's going on there? And I think what's going on there is it's really the equity people have in their home, which is the driver, especially overrides the house price decline for the reason of delinquencies. And it goes back to what Paul was saying about people being able to basically go through a voluntary sale and effectively move out of their position if they suffer financial stress. And so to give you a bit of an example, to give you a bit of numbers to bring some life to this chart is if you're in the lower North Shore, okay, their average LTV is about 56%, and the median house price is $1.1 million. So you've got equity in that property of about $485,000. So if you do suffer financial stress, what you can do is you can do a voluntary sale. If you see you've got to hit the wall, and then you can take that equity and buy another property. You can downsize basically with $485,000 worth of equity. However, if you're in outer Western Sydney, where the average LTV is, can't read it from here, about 66%, 67%, the median house price in that region is $360,000. So you've only got $120,000 worth of equity. Now, with $120,000 worth of equity around Sydney or even New South Wales, there's no region that you can buy a property in. But if you've got $485,000 worth of equity within New South Wales, there are 18 regions you can go and buy your property, buy another property. So what this is saying, if you want to wrap that up in a nutshell, is that people with lesser means buying lower value houses with less equity. And so that's what that's showing me. And the option for a voluntary sale, if they do get into financial stress, does become limited. So they try to hold on to that property, they get into delinquencies, and they just go like that. Whereas if you talk to, if you go on and you talk to the lenders, you talk to their collections people, what they try to talk to people, they say, listen, you've got so much equity in your place, why don't you sell it? You know, if they come up for hardship cases, they'll talk to them and say, why don't you sell your property, take what you get, rather than having accrued interest, eat away at your equity and move on with your life. So in and by themselves, house price declines aren't the main driver.
Well, maybe we switch gear to maybe interest rate. You know, given the Reserve Bank has recently, you know, had a rate cut. Matt, do you actually foresee any further rate cuts in the next 12 months?
Yeah, so in the baseline outlook, we do have one more rate cut on Melbourne Cup Day next month. So that'll bring interest rates down to 3%, so we're record low, as we saw in the crisis. Clearly, with the global environment on shaky ground and inflation pretty subdued, the RBA certainly has scope to keep cutting. I think a couple of other factors that they'll keep in mind are the strength of the Australian dollar and consumer and business confidence. If we don't see any improvement in confidence measures or any downward pressure on the dollar in coming months, then I think the RBA will have to go harder in 2013. So we could see more than one rate cut moving forward. But at this stage, the baseline calls for one rate cut.
So, Tim, do you think that you know, the interest rate cut will help with the property price? That you know, people are making it more affordable for people for you know, borrowers to enter into the housing market.
Well, I don't think it's a coincidence that we saw the market turn at the end of May. We saw a 50 basis point cut in May, of course, and 25 in June, and then another 25 in October. So the market's clearly very responsive to stimulus. We've seen that not just in interest rates, but also in stamp duty concessions, for example, that are available in the marketplace. A good example of that is in New South Wales, when the stamp duty concessions were available at the end of last year, the December quarter. We saw transaction numbers increase by about 25% over that quarter compared to the previous quarter, and they fell away quite quickly as the stimulus was gone. Same thing in Queensland. On July 1st, we saw transactions increase by about 50% between June and July. It really shows how responsive consumers are to a savings and to stimulus. Interest rates, clearly very broad, very macro level stimulus, and I think the big headwind here is we haven't seen consumer confidence responding to lower interest rates as it has in the past, and it really shows how conservative consumers are at the moment. They're really focusing on drilling down debt, deleveraging, not taking on high commitment decisions and more debt like property. So I think that's probably the hurdle to get over first, is an improvement in confidence before we can really see the market respond to lower interest rates.
Sure. And Arthur, do you think that, you know, with any sort of interest rate cut, it will help from a delinquency performance point of view?
It's interesting that Tim was saying confidence and stuff like that. Yeah. It's interesting because we've looked at the interest rate movement. Paul was saying you saw delinquencies move up about 2 years ago, and then they've come off. I've got a nice little slide if we've got it. I can talk about.
Can I have this next slide,
the
please?
effect of interest rates over this period. Okay, like Paul was saying, between March, or in the data that we've got, but it tends to correlate very closely with what Paul was just saying, is we saw between March 2010 and June 2011, we saw interest rates go up by 100 basis points or 1%. What we observed in our data, we saw delinquencies increase by 53 basis points. Okay, nothing really spectacular there. So we saw basically the chart move from green and yellows to, including a few more reds in there as delinquencies increased. But then when we had the easing of interest rates and we saw interest rates come off, if we've got a new slide there, we should have another slide. We saw interest rates come off by 100 basis points between June 2011 and May 2012. However, delinquencies only came down by 7 basis points. So what we're seeing is the rate increases have had about 7 or 8 times more impact than the rate decreases. And obviously the thing that's doing that is that in the past we used to be able to look at interest rates, the cash rate basically, the official cash rate, and sort of predict how delinquencies will move. Now the problem with that is that what we've seen since the financial crisis, we've seen banks pass on more of the increase and less of the decrease. And so if we go to our next slide, that's what's happened there. We take a look at the 4 majors. So interest rates, official interest rates went up 10%, 1%, they came down 1%, so you think, okay, I'm back to neutral, to where I was in 2010. But you're not. You're up 41 basis points, given the fact that there's been more of the increase passed on, less of the increase passed on, and actually in that period there we had 2 independent rate rises as well, moving out of step with the RBA. And so if you go on to a next slide, that just sums up the differences between the RBA cash rate and what the banks are charging. So if you see before the financial crisis, it used to be a flat line. Because the difference is, they used to move in lockstep. Now that they're not, we're seeing that margin moving out. So what that does, well, that raises the question as to moving forward, how much confidence we can take from the government's interest rate reductions leading to, or reducing, be able to reduce delinquencies. Because Matt said that, look, we've got, the government can move from its current 3.25% cash rate, but the thing is, well, okay, they're going to move, but how much of that is going to be filtered down to borrowers, mortgage borrowers, and how much comfort they can get from that. And I think that also, and the market's looking at that, borrowers are seeing this happen, and also taking off what Tim was saying as well is, that affects the consumer sentiment, especially when they're seeing things going around the world. So they're seeing what's happening, they're not spending, that then feeds back into lower retail sales, they're not travelling as much, so the tourism still gets hurt. So the effectiveness of official cash rates has to be we have to sort of rethink that moving forward, I think.
Maybe I can ask Graham, with your conversations with a lot of the mortgage lenders, what do you think will be the funding landscape in the next 12 months at least, or any impact in terms of the margin, for these lenders?
Thanks, Jennifer. Save the best till last.
Don't worry, we've got lots more for you.
As Arthur had up there on the slide, the margin now of 325 over the cash rate is interesting, and it's interesting for a couple of reasons. Firstly, for our non-banks, I think it starts to provide some positive net margin, and I'll explain why. So, if you knock off the average discount of about 80 points, you're roughly down at, say, 240. If you then look at the basis swap and you add in the AAA cost of, say, 140, you look at the cost of subordination, and you've now got a positive net margin of, let's say, somewhere to 50 to 60 points if you're trying to compete in the prime space. You then deduct your costs, so you've then got cost of pool insurance if you're securitizing, you've got broker costs, you've got servicing costs, and you've got trustee fees. But there is light for the first time in some while for our non-banks out there. I reckon there's probably 20 basis points of spread at the bottom. The major bank landscape is equally interesting. I think the game is changing. We've seen wholesale markets start to stabilise. When you look at the funding gap between our mortgage loan assets that's not funded by deposit funding, you've got roughly $600 billion across our major banks. So that's the that's the total gap in their balance sheets that's currently funded from offshore, mainly through the wholesale markets. Now, if you divide that by 4, you've got about 150 billion per major. Some of them are at the 100 billion number, some of them are higher than 150. You divide that by an average tenure of about 4 years, and you're looking at an annual funding task of somewhere between 20 billion and 40 billion, depending upon which major bank you are. Now, if you're all going to the market at the same time, all looking for similar investors, there's still a considerable challenge if you're a major bank tapping into our offshore markets. So combine that with what is the new game for majors, which is deposit funding in a relatively low interest environment. You can't go below 0 for a deposit for transaction accounts. And when you start to get to very low rates of interest, it's very difficult to keep cutting by the cash rate move. And as a consequence, there's increasing pressure on margins for our majors. If we do see further rate cuts from the RBA, then I think we'll certainly see our banks seeking to retain some of that as we go forward. And I don't see that that's avoidable in the short term.
Do you think that will actually further change the competitive landscape among the lenders in the market?
Yeah, on the competition side, we recently held a round table of many of the mortgage providers out there in Australia, and there's a view that competition is hot. And competition is measured by price, and if you look at the pricing of our mortgages and of our deposits, then certainly we're seeing pretty healthy competition out there. If you're looking for more choice from our lenders, then certainly perhaps we've got further to go. We see that as the topic of a bank inquiry going into 2013 as to looking at the competitive landscape and that whole question of competition versus stability. We did ask the question, looking out 3 years, where do we see competition for our majors coming from? Interestingly, the highest response was online lending, and there was a very interesting debate there as to whether you could go end to end with online banking for a mortgage product. Most viewed it as really an origination channel rather than an end-to-end settlement, but the view of that team was very much so that we might see a name brand like an Apple or a Google or a Virgin come into the market with that sort of product and start to disrupt.
Then, Paul, if I can ask you, do you think that this new renovation in the mortgage market could potentially change, the risk appetite of the lenders and potentially, likely impact on the performance of mortgages?
Well, if I look at risk appetite and just go back to what has happened over the last couple of years, is look, in 08-09, I think we did see a slight reduction in risk appetite, and as I mentioned earlier, there was a tightening in credit policy that occurred through the latter part of 2008 and 2009. Now, in addition to that, there was further restrictions that a number of lenders did place on high LTV lending, whereby some reduced their maximum LVRs down to the 80-85 or restricted it to existing customers. But that was fundamentally driven from a funding perspective as opposed to a quality credit concern. So what we have seen is effectively lenders have removed those funding limits that they did place, so LVRs have moved back up towards the 90-95 and the restrictions on existing customers have generally been removed. But the credit tightening that did occur in late 08 and 09 has fundamentally remained. I think we will continue to see those policies in place. So I don't think we're going to see any reduction in risk appetite over that period, being the next 12 months. If we do see a new entrant into the market, and I think a new entrant in the next 12 months is probably unlikely, and I suspect that it's going to try and enter into the market in the more kind of Ubank space, which will be lower LTVs, very vanilla. So again, I don't think we're going to see overt pressure from a risk appetite perspective or degradation in credit quality of books.
If I might just finish up with you on one last question, what do you see as the key factors which will probably impact on the mortgage performance, in the next year or two?
Look, mortgage performance, particularly in the higher LTV space, is primarily driven by unemployment and underemployment. It's driven by interest rates and where they're heading. It is driven by home price appreciation. And the fourth factor that we do see is credit quality. I think the credit quality, as I mentioned, for latter originations from about mid-09, I think is very good quality. And I think we are going to stay in that space from a credit quality perspective over the next 12 months. So it's really going to be the key macroeconomic factors. And unfortunately, I think that's going to be more dictated by Europe and whether Europe can actually get its act together and resolve its debt funding crisis. My personal view, however, is that at some stage they will. However, Europe is going to be at best case anemic for the next decade. And so I do think that is going to put ongoing, pressure's probably too strong a word, but we're going to see continued sluggish growth in Australia, and that obviously will feed through to slightly higher arrears, but I think it's going to be quite more than offset by the credit quality that we are seeing.
Sure, thank you. Unfortunately, I think we are a bit overrun, but and we did get some questions, during the session, and I do encourage you. I think some of our panelists will be staying behind at the Moody's booth. So, for those who has actually sent us the questions, I welcome you to come and visit our booth and ask the panelists on the questions that you have sent through. And maybe I'll just wrap up, and I think by thanking our panelists to be here today. So thank you all.
Thanks, Jennifer. We're now taking a coffee break. We'll be back at 11 o'clock. And if you've got your printed programs, you might find on the inside cover there's a voucher for a discount on the new ASF Applied Securitisation course. 25% off if you register your colleagues or yourself before the 17th of December. So please check that out. See you back at 11 o'clock.